Hello and welcome to our weekly global market outlook. I'm Tolga. After an early stumble, equities roared back last week on the back of blockbuster tech earnings and a temporary softening in US-China trade rhetoric. The NASDAQ gained almost 7%, Treasury yields retreated nearly 30 basis points, and gold flirted with a new record before slipping. But the International Monetary Fund cut its growth forecast and consumer sentiment gauge slid, reminding investors that tariffs are starting to bite. All of that sets the stage for the data-rich stretch that features first quarter GDP on both sides of the Atlantic, global PMI updates, a Bank of Japan decision, and the heaviest week of the US earnings season. Last week, US markets delivered a textbook relief rally. The S&P 500 climbed 4.6%, led by an 8% surge in information technology after heavyweights beat profit estimates. Small caps participated as earnings revision turned positive, while consumer staples lagged on margin worries. In fixed income, cooler than feared data and Chair Powell's wait-and-see message helped pull the 10-year Treasury yield back to 4.26%. The curve bull-flattened as recession talk resurfaced. The dollar index notched its first weekly gain since mid-March, though it remains below the psychologically important 100 level. Gold briefly pierced $3,400 an ounce before closing marginally lower, and Brent crude extended two-week slide on oversupply chatter. Europe echoed the risk-on tone. The Stoxx 600 added almost 3% after the European Central Bank delivered its sixth straight rate cut previously, and officials hinted at more if growth weakens further. Flash PMIs held just above the 50 break-even line, but Germany slashed its own growth outlook to zero, underscoring the tariff drag. In the UK, surprise strength in retail sales failed to lift sterling as inflation expectations stayed stubbornly high. Asian markets were mixed. Tokyo equities advanced nearly 3% even as a hot Tokyo CPI readings 3.4% kept pressure on the Bank of Japan to tighten later this year. Mainland Chinese and Hong Kong indices crept higher after first quarter GDP beat expectations, yet officials signaled fresh fiscal tools to cushion the looming impact of 145% average US tariff rate. Elsewhere, senior Turkish officials told the IMF meeting that tighter, proactive monetary policy was restoring disinflation and pledged to keep rates restrictive until price stability is secured. A deadly attack in India-controlled Kashmir prompted both India and Pakistan to suspend selected diplomatic and economic ties, but analysts judged neither side eager to escalate because of the current economic and financial background. Macro data told a slower growth story. US durable goods orders stalled outside the aircraft sector. Existing home sales plunged under the weight of 7% mortgages, and the University of Michigan Sentiment Index fell to a 4-year low of 52.2. The IMF followed by trimming its 2025 global GDP projections to 2.8%. Upcoming week, the data calendar is dense. Let's walk through the key releases. Monday opens quietly, though Spain's unemployment and the Dallas Fed survey will offer an early look at confidence. Tuesday, the focus shifts to sentiment. Germany's GFK reading, the Euro Area Economic Sentiment Index, and US Conference Board Consumer Confidence arrive alongside US JOLTs job openings data. Alphabet, Microsoft, HSBC, and Deutsche Bank report critical barometers for both tech spending and global credit conditions. Wednesday is the data crescendo. China releases official and Caixin PMIs, providing the first full month read on manufacturing since tariff escalation. Australia's quarterly CPI could sway RBA expectations, while France, Germany, Italy, and the broader Euro area publish flash GDP prints. Markets wants to know if Europe has skirted a recession. Stateside, the advanced estimate of US first quarter GDP is expected to slow sharply. Some models flag a possible contraction, alongside core PCE, personal spending figures, and ADP private payrolls update. Meta, Samsung, Barclays headline earnings after the close. Thursday is Labor Day holiday for much of the world, but Tokyo and New York remain open. The Bank of Japan announces a policy, no rate move is expected, yet Governor Ueda's outlook could jolt the yen. US ISM manufacturing and weekly jobless claims follow, just hours before Apple, Amazon, Shell releases results in thinner trading conditions. Friday is Jobs Day. Eurozone flash inflation is projected to ease back to ECB's 2% target, while US non-farm payrolls are seen decelerating to roughly 130,000, with unemployment holding near 4.2%. Wage growth and labor force participation will shape expectations for the 6-7 May FOMC meeting. Exxon, Chevron and Sony close out a blockbuster earning week, and markets predict for the weekend, still digesting any fresh headlines on US-China negotiations, Middle East tensions, or Canada's federal vote earlier in the week. To sum up, tariffs, tech earnings, and top-tier data are converging to test the fragile rebound in risk appetite. Investors will juggle a likely soft US GDP print, a pivotal payrolls report, and fresh signals from the Bank of Japan and the European Central Bank on how far they are willing to shield growth. Stay nimble. Volatility tends to spike when hard numbers collide with headline risk. If you found this outlook useful, drop us a comment, hit the like button, and be sure to subscribe so you never miss an update. From all of us here, thanks for watching, and we will see you next week.